Good evening. This is Warren Buffett, and I want to talk to you about something that sounds technical on paper, but lands eventually in the price of your groceries and the value of your retirement account. On the 12th of August 2025, a memo leaked from the White House. It described the president asking the Treasury Department to evaluate financial sanctions targeting Chinese banks that support chip exports. That is one sentence in an internal document. But markets read sentences like that the way a cardiologist reads a lab result. In the same month, China quietly added 32 tons of gold to its reserves. The average American never sees that headline. Yet if you own a home of $401k, a small business line of credit, or you're just trying to keep up with an extra $150 a month in living costs, you are in the blast radius of decisions like these. Let me bring this down to the level of one person. Imagine Linda, a 7-year-old retired teacher in Ohio. She thought $8,000,000 in mutual funds and a paid-off house would give her enough room to breathe. Over the last 2 years, her grocery bill is up 18%, her property taxes are up 12%, and the supplemental health insurance premium she needs has climbed another 9%. None of those numbers mentions dollar weaponization or Chinese banks, but all of them are downstream of how the world prices American risk. When a president openly toys with the idea of using the dollar system to punish major foreign banks, not for terrorism, not for war, but for industrial policy, in this case chips, he is not just playing hardball in a trade dispute. He is inviting the rest of the world to ask a simple question: if the backbone of global finance can be turned on and off like a political switch, how much of my savings do I really want tied to that switch? This is not rumor, it is a systemic signal. Reserve managers in Asia and the Middle East do not shout in press conferences. They quietly adjust their portfolios. They move 5% more of their incremental reserves into gold or into euro assets or into regional payment arrangements that sit one step further away from Washington's reach. That is what 32 tons of gold in a single month really is. Not a bet that the dollar vanishes tomorrow, but a hedge against the possibility that the rules governing it are becoming less restrained, less predictable. And for most of my lifetime, the United States benefited enormously from something you cannot see on a balance sheet: institutional credibility. The world believed that while American politics could be loud and messy, the core financial and legal plumbing around the dollar was disciplined, bounded by law, and used with some sense of restraint. When you start drafting memos about turning access to that plumbing into a routine pressure tool in an ongoing power struggle with the world's second largest economy, you are spending that credibility. The first place that spending shows up is not in a crash, it's in basis points. Maybe foreign buyers demand 30 or 40 basis points more on a 10-year treasury to compensate for what they now view as an extra layer of political risk. Maybe they shorten the average maturity of the debt they are willing to hold because they don't want to be locked in if sanctions expand. You don't see a headline that says dollar weaponization tax costs you $600 a year, but the effect on a household can be just that, mechanical. Think about the small manufacturer in Michigan rolling over a $5 million loan. If the interest rate on that loan rises from 5.2% to 5.7% because global investors are quietly demanding more compensation to hold U.S. paper that is an extra $2,500 a year in financing costs, that money has to come from somewhere, from wages that don't rise, from investments that don't get made, from prices that rise faster than they otherwise would. For Linda, the retiree, it may mean her grocery bill doesn't go up 18%, it goes up 21%. The math is not dramatic in any single step, but it compounds. The shock insight here is straightforward. The biggest long-term damage from using the dollar as a weapon does not happen to the target first. It happens slowly, cumulatively to the country that issues the weapon. That damage shows up as higher structural pressure in the cost of capital, subtle real income losses for households, and a steady misalignment between how powerful a nation thinks its tools are and how much the rest of the world is willing to tolerate their use.
I've lived through currency crises, oil shocks, double-digit inflation, and the global financial crisis. What makes this moment distinct is not the size of any single move, but the direction of travel. Each time you broaden the reasons for which the dollar network can be selectively shut off, moving from punishing clear illegal conduct to punishing policy choices, you create a little more systemic tension. You encourage every rational actor outside your borders to ask, what is my plan B? In investing, when you see a series of small rational hedges piling up on the other side of your trade, you do not shout at the traders.
you ask what they are seeing that you are not acknowledging. China buying 32 tons of gold in the same window as a memo about sanctioning its banks is a hedge. Europe talking more openly about strategic autonomy is a hedge. Multinationals exploring non-dollar invoicing for some trade flows is a hedge. Back in Omaha, people will say, Warren, this is all very global. I just want to know if my savings are safe. The honest answer is that your savings are sitting on a foundation that is strong but not indestructible. And every time we treat the dollar system as an all-purpose pressure device rather than a trusted utility, we chip away at that foundation. You do not feel it on day one. You feel it years later when the economy seems more volatile than the news flow explains, when yields don't fall as much in a downturn as textbooks suggest, when the next recession bites a little deeper into ordinary households. The memo was one page. The gold purchase was one line on a central bank balance sheet. Together they are a reminder that trust in money is not just about printing presses and GDP. It is about how seriously you take the responsibility that comes with issuing the world's reserve currency. That responsibility is being tested, and the bill for any failure will not arrive at the White House first. It will arrive in mailboxes like Linda's. If you follow the chain from that memo to the gold purchase and then forward into the real economy, you start to see a lattice of risks develop. These are not abstract. They are economic, legal, and institutional. They press on families, on companies, and on the credibility of the system itself. Begin with tariff-induced inflation, when the same administration that is willing to explore financial sanctions on Chinese banks is also leaning on tariffs as a primary policy tool. The result is a double squeeze. On the front end, import prices rise. A 15% tariff on a $50 billion basket of electronics and machinery does not stay on a customs form. It migrates into a few extra dollars on a router, $200 more on a washing machine, and higher input costs for manufacturers who use those components. On the back end, if the dollar's role is questioned and foreign capital becomes more cautious, the cost of financing that extra fiscal and trade experimentation rises. That is how you get a feedback loop between trade policy and inflation. Tariffs lift prices directly, and investor skepticism about unpredictable policy widens risk premia, which lifts financing costs and feeds into prices indirectly. Households sit at the intersection of those forces. Real income erosion is not a theory. It is the difference between a 3% nominal wage increase and a 4.2% rise in the cost of the basket you actually buy. For a mid-career engineer making $9,000 a year, that gap may be a few $1,000s lost annually. For a warehouse worker at $4,200, it's the difference between paying down a credit card and carrying a balance at 22% interest. When tariff-induced inflation combines with higher borrowing costs driven by investor worries about institutional credibility, you get structural pressure on living standards that is not easily reversed by a single rate cut or tax rebate. Shutdown risk and federal paralysis add another layer. When a president pushes the envelope on tariffs, emergency authorities, and financial sanctions, Congress often pushes back, not always in coherent ways. The threat of government shutdown becomes a recurring bargaining chip. Each time Washington stumbles toward a funding lapse, markets reprice the odds that the United States is willing to toy with its own creditworthiness. A technical shutdown that delays $25 billion of federal payments for a few days might not look like much against a $28 trillion economy, but for the households waiting on paychecks, refunds, or benefits, it is a direct liquidity shock. The longer this pattern persists, the more it creates a perception of governance, misalignment, a country willing to risk its own basic operations over short-term political standoffs. Now consider institutional credibility as a distinct asset. When the line between economic policy and political tactic blurs, institutions like the Treasury, the Federal Reserve, and the courts are pulled into the arena. If Treasury lawyers are routinely asked to stretch statutes designed for genuine emergencies to cover routine trade or technology disputes, the perception of legal overreach grows. If the courts are pressured to validate broad interpretations of emergency powers to shield controversial tariff and sanctions packages, their role as neutral arbiters is called into question. Over time, this erosion of institutional credibility weighs on how both domestic and foreign investors view U.S. risk. Even if the economy expands at 2%, the perceived volatility around that path rises because the rules feel more contingent. For businesses, regulatory fog becomes a constant condition rather than an occasional weather pattern. A multinational that depends on Chinese suppliers for specialized components reads that August memo about potential banking sanctions and has to imagine multiple future states of the world. In one, sanctions are never imposed. In another, they are narrow and time limited. In a third, they expand into secondary sanctions that touch European counterparties and create cascading complications. Under that uncertainty, expansive capital projects are delayed. A $700 million plant expansion becomes a $50 million pilot. A 3-year hiring plan becomes a 1-year rolling decision. This is not cowardice. It is rational capital behavior under conditions of systemic tension and regulatory fog. Cash levels on corporate balance sheets tell the same story. When executives see a policy environment where tariffs can jump 10 percentage points by tweet and reserve currency access can be dangled as a bargaining tool, they hoard liquidity. They keep an extra 5 or 10% of assets in cash and near cash securities instead of in long-term investments. That looks prudent on a single balance sheet. In aggregate, it is a drag on productivity growth. The economy gets more balance sheets that can survive a shock and fewer projects that raise long-run potential output. The misalignment between what capital markets could fund and what they actually fund grows. The political side effects are non-trivial. Inside the Republican Party, there are fractures between traditional pro-business factions and a more confrontational wing that sees tariffs and financial coercion as tools of national restoration. When a president leans into dollar weaponization and broad tariffs simultaneously, the old coalition that relied on predictable trade rules and steady monetary policy starts to fray. CEOs who once assumed that Republican administrations would broadly support open trade and limited government interference now find themselves recalculating. Some go quiet publicly while moving supply chains out of the line of fire. Others begin to hedge their political relationships, supporting candidates in both parties who promise stability over volatility. This internal GOP misalignment feeds back into markets as another source of uncertainty. No one is quite sure what pro-market means anymore in American politics. Diverging economic indicators add to the complexity. You can have a strong headline, labor market unemployment at 4.1%, job openings still high, coexisting with sagging consumer confidence and weak small business sentiment. Equity indices can remain elevated because large firms with diversified operations and strong pricing power are able to manage the environment even as smaller firms struggle. That divergence is not accidental. Large firms can navigate regulatory fog and rewire supply chains across continents. A 40-person manufacturer in Indiana cannot. As supply chains reroute, more production shifted to Vietnam, Mexico, or India to avoid tariff lines. More invoicing in non-dollar currencies to reduce sanctions risks the strain on U.S. Small and medium-sized enterprises become structural. For these SMEs, every incremental twist in the sanctions and tariff regime is a new compliance cost, a requirement to certify that no input comes from a sanctioned entity, a need to renegotiate contracts because a bank in the chain has been targeted, a shipment delayed at port because a new rule was rolled out with little notice. This translates directly into real economy consequences: fewer hires, lower wage growth, more bankruptcies at the margin. When you multiply that across thousands of firms, you get a quieter but deeper confidence fracture among business owners about the stability of the policy environment. On the global stage, supply chain rerouting and long-term shifts in trade architecture become more than a slogan. If you are a European car maker or an Asian electronics firm, you start designing networks that are less exposed to any single jurisdiction's whims. You may still use dollars, but you make sure that alternative invoicing and finance channels are viable. You may still build plants in the United States, but you temper that with footprints in other markets where trade policy seems less volatile. Over a decade, that behavior changes the map of where capital flows, where jobs are created, and where innovation clusters. The United States still attracts investment, but the premium it once enjoyed from being the unquestioned center of a predictable dollar system begins to narrow. Markets respond to this mosaic of risks in their own language. The term structure of interest rates becomes more jittery. Volatility indices spike not only around earnings seasons and central bank meetings, but around trade announcements and sanction rumors. Credit spreads for certain sectors, export-dependent manufacturers, logistics firms, banks with large cross-border exposures widen in ways that are hard to explain by fundamentals alone. That is the signal of a system where political economic feedback loops are dominating traditional models. When traders say headline risk, what they increasingly mean is policy risk tied to a narrower circle of decision-making, unconstrained by the norms that previously guided use of tariffs and sanctions. In that environment, the feedback loop between politics and markets tightens. A trial balloon about new sanctions can move exchange rates. A leak about internal disagreement in the administration over tariff levels can shift equity valuations for entire sectors. Politicians see markets react and conclude that the tools are powerful. They are tempted to use them again. Each iteration amplifies systemic tension. Investors holding long-duration assets, 20-year bonds, infrastructure, equities, pension liabilities, have to discount a future in which the rules of engagement are less stable and the discount they apply shows up as higher required returns and lower present valuations. What makes this particularly dangerous is that there is no single tipping point. There is no alarm that goes off when institutional credibility has declined too much. Instead, you get a series of almost invisible reallocations of risk and reward. A sovereign wealth fund that used to hold 65% of its safe assets in treasuries moves to 55%. A central bank that once rolled over all of its dollar reserves into similar maturity starts to shorten duration and add gold on the margin. A multinational that would have built its next 3 facilities in the United States opts for 1 here, 2 abroad. Each move is rational.
Collectively, they represent a slow erosion of the premium the United States has long enjoyed as the issuer of the world's primary reserve currency.
The August memo and the 32 tons of Chinese gold are not isolated curiosities. They sit at the intersection of tariff-induced inflation, household strain, federal paralysis, risk, institutional credibility, erosion, regulatory fog, defensive capital behavior, partisan misalignment, diverging indicators, SME stress, and global supply chain recalibration. This is the architecture of a system that is becoming more brittle, even while surface numbers, GDP, unemployment, stock indices can still look healthy. When you have watched markets long enough, you learn that it is often in those periods of apparent health that the deepest mispricing of risk occurs. If you step back from the month-to-month data and look out over 10 or 20 years, the question is not whether one memo or one batch of gold purchases will change the world. The question is what kind of trajectory we are choosing for the institutions that underpin the dollar and the global system built around it. For decades, the United States enjoyed a compound advantage, economic scale, military reach, and a legal institutional framework that most of the world trusted more than any alternative. That trust did not mean that America's decisions were always wise or popular. It meant that on balance, other countries believed that the rules of the game would not be rewritten casually to gain a temporary edge. When a president flirts with turning reserve currency access into a routine bargaining instrument in a strategic competition with China, he is implicitly redefining that understanding. Over 10 years, this redefinition manifests as structural erosion, not in a dramatic collapse, but in the slow narrowing of the gap between the United States and the second best option. More trade is invoiced in euros, yuan, or local currencies. More regional safety nets, Asian swap lines, European stabilization mechanisms, cross-border digital payment systems are designed with the explicit aim of reducing dependence on U.S. infrastructure. More investors hold a diversified basket of reserves, with gold occupying a larger share than it did in the very low inflation, high trust environment of the early 2000s. None of these moves replaces the dollar, but together they turn an overwhelming dominance into a strong plurality. Institutional decay in this context does not mean corruption on the front page every day. It means a gradual lowering of standards for when and how powerful tools are used. Emergency powers that were once reserved for wars and genuine systemic shocks become instruments of convenience in trade disputes. Legal justifications stretch. Oversight weakens. Judges, regulators, and central bankers are selected more for their alignment with immediate political goals than for their independence and competence. Over a 20-year span, that shift changes the character of the system. Foreign observers begin to see less of a rules-based guarantor and more of a state comfortable using its central role to advance short-term tactical aims. Market trust degrades in parallel. Investors still buy treasuries, but the implicit assumption that U.S. policy will prioritize long-term stability over short-term leverage starts to fray. When a future administration faces a choice between exploiting the system's embedded power for a political win or preserving its neutrality for another decade, the precedent set today will matter. If the pattern over multiple presidencies is one of frequent experimentation with aggressive tariffs
targeted sanctions in gray zones, and brinkmanship over basic funding bills, the discount investors apply to U.S.
assets for governance risk will rise. Over 20 years, even a modest increase in that discount can mean trillions of dollars in higher cumulative interest costs. The lesson from a lifetime of allocating capital is that systems rarely break at the point where outsiders start to worry. They break at the point where insiders have become so accustomed to stretching their advantages that they no longer recognize the limits. You can run an economy with elevated debt, complex geopolitics, and even periodic political dysfunction if the core institutions maintain discipline, clarity, and humility about their responsibilities. You cannot do so indefinitely if each of those institutions is gradually repurposed as a vehicle for tactical pressure. Structural erosion has a particular pattern. First, small stresses are absorbed easily. The system appears robust. Then, as more stress accumulates, more tariffs, more aggressive uses of sanctions tools, more episodes of federal paralysis, the margin of safety shrinks. Actors respond defensively, more hedging, more diversification, more regionalization. Growth slows at the edges. Productivity disappoints. Politics becomes more polarizing as households feel pressure that headline numbers do not fully explain. Finally, when a new shock arrives, perhaps a financial accident, a geopolitical crisis, or a technological disruption, the system's weakened state turns a manageable problem into a much larger one. The uncomfortable truth is that Rui Rotik Lui, the risk that builds quietly, does most of the damage. Each memo that stretches an emergency authority, each sanction package that pushes closer to major banks and a rival economy, each tariff flurry justified as a negotiating tactic adds a small increment of fragility. At the moment of decision, the costs look minor and the benefits tangible. 10 or 15 years later, the cumulative effect is that capital is more cautious, global finance is more fragmented, and the American household faces a future with more volatility and fewer clear guarantees. From where I sit, the core lesson is not ideological, it is arithmetic. Trust in a financial system is built up slowly by consistent behavior and lost more quickly when that behavior changes. Discipline in the use of powerful tools is not a moral luxury. It is a practical necessity if you want those tools to retain their effectiveness. Clarity about the boundaries of authority, what emergency powers are for when sanctions are justified, how trade policy is set, is a key part of how markets price long-term risk. Humility, the recognition that even a powerful country cannot bend global finance indefinitely to its will without consequences, is the trait most often in short supply when damage is being done. Over the next 2 decades, the real contest is not just between the United States and China. It is between 2 possible futures for the dollar system. In one, the United States recommits to treating its monetary and legal infrastructure as a global utility first and a political instrument second. In that world, the dollar remains central. Investors continue to accept relatively low yields on U.S. debt, and ordinary Americans benefit from the quiet subsidy that comes with issuing the currency everyone else wants to hold. In the other future, the temptation to weaponize that system grows, the line between emergency and convenience blurs, and the world responds with diversification, regionalization, and hedging. In that world, the privilege remains, but it is thinner, more contested, and more expensive to maintain. Households will not experience this as an abstract shift. They will experience it as a pattern of disappointments, lower real wage growth than the headline productivity numbers would suggest, more frequent bouts of financial turbulence that hit retirement accounts unexpectedly, public budgets squeezed by higher interest costs, leaving less room for infrastructure, education, or health care, a general sense that the economy is working harder just to stand still. Politicians will debate the causes, technology, trade, demography, but the underlying misalignment between how the system is used and how it needs to be used to retain global trust will be a major contributor. After 70-plus years of watching capital move, I have come to believe that markets are not moral, but they are attentive. They notice when behavior drifts. They notice when promises are stretched. They notice when institutions that used to exercise restraint begin to treat that restraint as optional. They do not react all at once. They reposition gradually, then suddenly. So the warnings I would leave you with are simple. Arithmetic does not negotiate. Markets smell uncertainty. You cannot spin a grocery bill. Institutions matter. When you shift from the next quarter to the next 20 years, the story stops being about headlines and starts being about arithmetic. You can argue with ideology, you cannot argue with compound interest on a national balance sheet. And right now, the United States is running deficits that hover in the 5 to 7% of GDP range, depending on the year and the assumptions. Debt held by the public is on a path that in many projections pushes toward or beyond 120% of GDP over the coming decade. For a long time, this looked manageable because the cost of carrying that debt was historically low. When your average interest rate on federal debt is 2%, a $30 trillion debt stock implies $600 billion in annual interest. Painful but bearable in a $28 trillion economy. But the moment global investors begin to quietly add a risk premium for institutional drift and dollar weaponization 1.02050 basis points over where yields would otherwise be, the whole fiscal picture bends. Move that average rate from 2 to 3% on a larger stock of debt a decade from now, and you are talking about interest costs crossing $1 trillion a year, even if you avoid a crisis. That is more than the United States currently spends on many cabinet departments combined. The crucial link is simple. When you treat the dollar system as a flexible negotiating tool rather than a trusted utility, you nudge investors to require a little more compensation for holding your paper. That little more becomes structural. It doesn't go away after one election. It gets baked into how pension funds, central banks, and insurers model U.S. risk. Over 20 years, that is not a market quirk. It is a fiscal regime change. Higher structural interest costs force trade-offs that no slogan can erase. You can cover them with higher taxes, lower spending on programs, more borrowing, or inflation that erodes the real value of the debt, but you cannot make them disappear. In practice, that means more of each tax dollar goes to paying for decisions made in the past, and less is available for investments that raise future living standards. When interest becomes the fastest growing line item in the federal budget, you are not just misallocating money, you are mortgaging political flexibility. The risk to the American standard of living is not that it suddenly collapses, it is that it stalls. You get an economy where headline GDP still grows, where averages still creep upward, but where the median retiree, the median worker, looks back after 20 years and realizes that their purchasing power never really broke free. Wages lag the true cost of housing, health care, and education. Public infrastructure ages faster than it is replaced. Opportunities for upward mobility narrow in ways that statistics only partially capture. In that kind of world, a 70-year-old former factory worker in Pennsylvania sees his Social Security check rise by a formula tied to consumer prices, but his property taxes rise faster because local governments are also paying higher interest. The Medicare Trust Fund is strained by demographics and by the federal government's own interest burden. A small change, maybe a higher Part B premium here, a quiet reduction in benefits there, creates a long, slow squeeze on real living standards. He doesn't need to know the term reserve currency risk premium to feel that something is off. For investors, particularly those managing retirement assets, the shift shows up as a persistent tension between nominal returns and real security. Equities may still offer decent nominal gains, but volatility around policy shocks is higher. Bond portfolios that once provided stable ballast now carry more sensitivity to political risk embedded in interest rates. Traditional 60-40 portfolios are harder to manage because both sides of the equation are contaminated by governance uncertainty. You can still compound, but the path is bumpier and the margin for error narrower, especially for those who cannot easily extend their working years. If you look further out at a 20 or 30-year horizon, the more profound change is in the architecture of the dollar's role. A world in which the United States is seen as a disciplined steward of the reserve currency is a world in which the dollar's dominance is self-reinforcing. Trade is invoiced in dollars because everyone trusts that the system around it is neutral. Capital flows into treasuries because they are the benchmark of safety. Crises elsewhere push money into the United States, lowering borrowing costs just when they need to rise least. That is the world my generation invested in. A world in which the United States repeatedly uses access to the dollar system as a tactical lever in disputes with major economies is different. In that world, the dollar remains central because there is no ready substitute of equal depth and liquidity. But the instinct of other actors is no longer to default to dollars. It is to ask where using dollars might expose them to sudden policy shifts. That is how you get gradual reconfiguration rather than overnight replacement. More bilateral deals in other currencies, more regional arrangements, more gold in official reserves, more digital payment rails designed explicitly to route around U.S. jurisdiction if needed. From the vantage point of Washington, that can be easy to underestimate. If 55 or 60% of global reserves are still in dollars 20 years from now instead of 70%, it may look like continued dominance. But the marginal change matters. It is at the margin where auction yields are set, where swap lines are drawn, where crisis interventions succeed or fail. A thinner safety net is still a safety net until it isn't enough. For older Americans, the implications of a thinner, more contested dollar system are subtle but real. A retiree who depends on fixed income instruments will face an environment where nominal yields might be higher, but where inflation and currency volatility erode the comfort that those yields used to provide. An investor who holds a lifetime of savings in dollar assets will face a world where diversification into non-U.S. assets is less a speculative choice and more a defensive necessity, yet harder to execute safely without sophisticated advice. The mental model that keeping everything in U.S. dollars is the safest option becomes less obviously true, and that ambiguity itself is a source of anxiety. There's also a political dimension. When living standards stagnate and fiscal space is constrained by higher interest costs, politics tends to polarize. Voters look for culprits. Sometimes they blame trade, sometimes immigration, sometimes technology, sometimes the other party. Rarely do they see that part of the strain comes from decisions made years earlier about how casually to treat the privilege of issuing the world's reserve currency. That disconnect can fuel policies that make the situation worse: more tariffs, more erratic tax changes, more pressure on the very institutions that need to be insulated if trust is to be rebuilt. From an investor's perspective, and as someone who has spent a lifetime allocating long-term capital, the prescription is not exotic. If you want a stable fiscal future, a sustainable debt burden, and a standard of living that continues to rise for the median American, you have to protect the foundations that keep your cost of capital low. That means using sanctions carefully, not casually. It means treating emergency economic powers as extraordinary tools, not everyday bargaining chips. It means recognizing that every short-term advantage squeezed out of weaponizing the dollar system carries a long-term cost in how the world prices your promises. If there is a silver lining, it is that this is still a choice. The United States has enormous residual strength, an innovative economy, deep markets, a legal system that, while strained, is still more predictable than most of its competitors. But strength does not exempt a country from the rules of compounding. You can compound trust or you can compound doubt. The fiscal math, the debt dynamics, the living standards of retirees and workers, and the shape of the dollar system over the next 20 to 30 years will reflect which of those you choose to accumulate. Arithmetic does not take sides. It simply keeps score.